We often turn to you to talk about the tech trade. What is your view of the tech trade this morning on the back of that Alphabet ruling and the idea that both Alphabet and Apple are winners in this situation, where a lot of people were worried about a worst case scenario where that $20 billion deal between the two could be broken up?
Short-term relief for Apple and Alphabet. At the end of the day, they have genuine competition over the next 3 to 5 years because of the transition to software 2.0, which means that companies like ChatGPT, Grok 4 and so forth are now actually encroaching on Google search. So whilst today the stock price is up for both Apple and Alphabet, we think this is a short-term relief, but it doesn't change the competitive dynamics going forward.
All right, it doesn't change the competitive dynamics. I want to talk to you more broadly about mega cap tech, specifically the Mag-7. If you're an investor right now, do you need to be overweight this group of stocks for the growth and when it comes to earnings from them and also protection? A lot of times we see investors turn to these names when there is that geopolitical uncertainty that we're talking about going on in China with the leader of North Korea, India, and also other leaders there meeting in China and basically showing some resistance to U.S. policy. Do you still see the Mag-7 as necessary for earnings growth and also a safety trade? Does it have that dual kind of side to it?
Yeah, they've been amazing investments for the last decade. Going forward, we think you've got to be more selective. So you just can't buy the Mag-7 and expect to generate good returns going forward, because sustainable growth and structural growth going forward is no longer locked on for these names. So we are very positive on NVIDIA, on Meta and on Tesla going forward, because they have very strong competitive positions. They've got very good structural growth over the next 5 years, and they don't have the same competitive threats that, say, Amazon, Apple, Alphabet do have.
All right, you like cybersecurity right now. Now, in all fairness, cybersecurity for most of the year has underperformed. We've seen some consolidation in cybersecurity as well with the deal with Palo Alto buying CyberArk. What else are you seeing there as a tailwind? Because we think we're getting rate cuts, which hypothetically would be good for them because companies might have more money to spend on cybersecurity. We've seen some deals getting done in the space too, which seems to boost certain sectors. What's going to be the thing that's the catalyst for this group going forward?
So going forward over the next 5 years, we're looking for structural growth, which can deliver 20+% continuously year on year. As we go through AI moving from experimentation within organization to deployment, what we're seeing is we're seeing value move up the stack. So from the infrastructure layer, so from companies that have benefited very well over the last 3 years from the build-up of AI infrastructure, like NVIDIA, like Broadcom, like Arista, we're now starting to see companies that operate at the top end of the application layer starting to execute. Those companies now have structural growth vectors that didn't exist before. So cybersecurity in particular, we've now got threat actors that have increased capabilities, so more cyber threats, but also we've got AI agents which are going to be operating within the organization. So areas of opportunity for the next 5 years is really around identity, really around cloud protection, and then also endpoint protection. So think about SailPoint for identity, Zscaler for zero tolerance, and also endpoint as CrowdStrike.
Zscaler reporting after the bell today, actually. I got to talk to you about the bond market. I know tech's really your wheelhouse, but as we look at the 30-year here in the U.S., pretty close to 5%. We also see yields over in Europe moving higher. What does that do to investor confidence in the equity market, and does it even create some competition for equities?
So the market's moved a long way since the bottoms in April, and so we're not surprised there's a period of digestion happening as we speak today. What we do expect is a period of softness for the next 3 to 4 weeks before earnings reveal themselves in October. We are watching very closely the 30-year Treasury, which is bumping up against 5% as we sit today. And so we do expect periods of softness over the next 4 to 5 weeks, but what we're looking for is opportunities to make more investments in structural growth.
So what are you watching for? If you're still looking for opportunities, what are you watching for? What happens if it bumps against 5%, which it's doing right now, or if it crosses 5%?
So we've seen some negative stock price action over the last 3 to 4 trading days. What we want to see is a further shift down before we start putting capital to work.